All right. Hello, everybody. Apologies for the delay while we've been working through some technical issues here. Um, my name is Timothy Willis. I head up RiskSpan's governance and model risk management practice. Our topic today concerns the application of model validation principles to anti-money laundering tools. AML reviews have some unique characteristics relative to other types of model validations, and they require a blend of skills since they can be quite data intensive, and they also require validators who are well versed in system implementation in general and BSA, AML requirements in particular. So we intend to touch on each of these topics today. We appreciate your investing this time with us, and as always, we'll do our best to make it worthwhile. Okay. So joining me on today's webinar are Susan Devine and Chris Marston. Susan is an independent consultant with extensive experience assessing BSA procedures and reviewing AML systems. She frequently works as a subject matter expert on AML and other model validation engagements that comply with supervisory guidance, SR 11.7 and OCC 2011-12. She also develops and documents processes, business requirements, security requirements, networks, system development lifecycle activities, all of which tend to play a more outsized role in AML validations than in some other types of model validations. And Chris Marston is a senior data analyst at RiskSpan who works on a variety of projects, including AML and other model validations. He has considerable experience and expertise getting familiar with complex webs of transaction data in order to determine whether AML systems are getting all of it and making appropriate use of it. I'm going to begin today's session with a brief introduction to how we typically go about aligning the components of an AML BSA review with the components of a model validation. Those things don't often feel like they were exactly made for each other. So after that, I'm going to pass you over to Susan, who will review these components in greater detail. She'll also talk about best practices in reviewing an AML risk assessment, evaluating how customers are risk scored, ensuring that all transactions are covered and accounted for, watchlist filtering, country risk scoring, and ongoing monitoring and reporting. So following Susan's remarks, Chris Marston will get into some of the details behind how we tackle some of the data challenges associated with above the line and below the line testing. And we should have some time for questions at the end. So along the way, please feel free to enter any questions you might have into the question box in the GoToWebinar panel. So let's start here. If you're participating in this webinar, chances are you've read the supervisory guidance on model risk management and the requirements of OCC 2011-12 and SR 11.7, and you know that the requirements those documents set forth for model validations, it would appear that they were not written with anti-money laundering applications in mind. Consequently, attempting to apply what we think of as the three central pillars of model validation, conceptual soundness, process verification, and outcomes analysis, trying to apply those to AML models can sometimes feel a little like trying to fit a square peg into a round hole. And so one of the main things we're going to attempt to accomplish in this session is to explain how we approach ticking off the various model validation boxes when looking at AML models and what several of those tests entail. So ultimately, of course, there's more than one way of bucketing these processes. This slide depicts one way. We typically use the conceptual soundness section of an AML model validation report to address things like the AML risk assessment and the way in which customers and countries are risk rated by the bank, the type of methodologies that are applied, how smart the rules are, whether they are risk-based or tied to the inherent riskiness of customers. We look at the documented and undocumented limitations and assumptions of the AML system, as well as an assessment of where the data is coming from, maybe how airtight the seal is between the various transaction systems and the AML engine, and just generally whether the tool is being implemented properly. So that's conceptual soundness. The process verification and benchmarking section of the report usually includes an assessment of key performance indicators, how the model is tuned and calibrated, and the model's approach to watchlist filtering. Finally, things like above the line and below the line testing and output reports we generally discuss in the outcomes analysis and back testing section of the report. So while this is certainly not the only way to do it, it's generally helpful to have some systematic way of demonstrating to an examiner, an examiner or anyone who happens to be reviewing the report, that you're ticking all the boxes, both from the AML BSA side of things and from the SR 11.7 OCC 2011-12 side of things. This is one way of doing it that seems to work. So I'm now going to try to hand it off to Susan, who will discuss some of these components in more detail. Susan, are you there? Can you hear me?
I am here. And just to follow up on what Tim was saying about how the regulatory guidance for model risk management is really not geared toward an AML model. That guidance was really written with more financial models in mind that use regression analysis and other statistical types of analysis that test balances and predict, estimates. With AML monitoring, it's really a transaction-based system. So we did have to, over the course of multiple validations in this area, develop a systematic and consistent approach to validating these types of models, and that's what we're going to be discussing today. In the conceptual soundness area, we always look at the risk assessment. This is very important regulatory requirement. It's covered extensively in the BSA examination guide, but it's also very important for banks to implement because it provides the foundation for risk-based monitoring, which is the industry standard and the best way to gear your resources toward those transactions, customers, products that pose the most risk to your institution. The risk assessment really drives the conceptual soundness of everything that follows. The purpose of a risk assessment is to obtain an enterprise-wide view of the AML risks, and it extends the KYC practices and policies, and it integrates the KYC risks with product risk, service channel risk, geographic risk. It's a way of really combining all those into a single perspective. A risk assessment develops over time and has to be amended as the customer profile, products, geographies change. And as the industry and money laundering practices and behaviors change. It is a data-driven exercise, and data obtained is both quantitative and qualitative. The quantitative data is numbers of customers, numbers of transactions, numbers of products, how those are sliced and diced, and how they integrate the number of high transaction customers that participate in high risk products, those types of things that need to be measured and quantified. But there's also a very important qualitative aspect to a risk assessment, and that's the input from the lines of business. And they help not just identify important controls that mitigate risk, but they also help the compliance department identify risks that are changing. I have several times been in a validation where a line of business has identified a new product that the compliance department was not aware of, and changes to product codes or transaction codes that were changed, and the compliance department was outside of that loop of information. So just gathering the input from the lines of business is very important. It's usually done by a questionnaire. It can be incorporated into an ERM questionnaire that's sent around quarterly or semi-annually or even annually. But for AML risks, I think it's a really good control to also add an interview with key business lines, because this is where you obtain an understanding of any changes. You can get more in-depth information about how they apply controls and really assess whether or not those controls in place really mitigate the AML risks that you've identified with your quantitative information. At the conclusion of a risk assessment, you need a methodology to help you measure the risk. So you have the data, you have the internal controls input, you know your products, your services, your locations, you know about your customer profile. Well, how do you risk rate that? So this is the methodology that we discuss in the conceptual soundness part of the report. And many methodologies can be used. It's interesting to see every place we go, there is always a different methodology. It is bank specific, and it should be tailored to where your risks are. The most important thing to do with a risk assessment is to use it. I have seen a very high quality risk assessment be performed and concluded and draw wonderful information from across the enterprise, and then it's never aligned with the scenario design, with risk-based due diligence even. It's just put to bed. It's a wonderful risk assessment, but it's never really used to be the foundation for everything that comes after it. So you can use it to, of course, identify high-risk customers for extended due diligence, and you can definitely and should be using it to help you design your scenarios. Where do we want to trigger our scenarios and rules? Where are our highest risks? And where do we want to most heavily monitor? Those are the questions that you can ask yourself and use the risk assessment to answer. And then it's also can provide a lot of information about setting thresholds for risk-based monitoring. So at the conclusion, you will have very good knowledge of what your AML risks are, how your enterprise is dealing with them, and how your scenario should be designed to address the residual risks. And we're ready to talk about the risk-based monitoring and due diligence now. One of the chief components of the risk assessment is identifying high-risk customers. And this is to support risk-based monitoring of the customer base. Risk-based monitoring lets a compliance department focus analyst resources on the high-risk customers. It is extraordinary to the monitoring. This is a more in-depth, manual, human review, and it's an important part of your overall AML compliance activities because it provides you with an opportunity to study a customer, a set of customers over a period of time, look at their transactions, and understand their behaviors. It can be used to identify which customers or alerts you need to put suppressions on because it's normal behavior. It is not risky for AML. Does not pose any risk. And risk-based due diligence can be used to actually suppress alerts on specific customers or transaction types for specific customers. It is also another use is if you're not getting an alert for particular rules, it could be used to verify that, yes, those rules are in place, they're quality rules, the thresholds are appropriate, and we're not getting alerts because we don't have those risks present in our transaction base. It can also be used to assess data quality because you're looking at the raw transaction data. You can see whether or not you're getting the full information you should. This, for example, is particularly valuable on international wires where the ultimate recipient may be embedded in a description field or where there may be intermediary banks. Can you trace that full transaction? It's also useful in looking at the beneficial owner or all of those records tied together. So it can really give an analyst an opportunity to do a deep dive into a set of transactions and understand the quality and the completeness and accuracy of that data. It also gives analysts a chance to see changes in high-risk customer behavior over time, the new types of behaviors that have not been accounted for before, particularly important when you have new products or service channels, and to ensure that those are appropriately monitored. For example, this is several years ago, we were doing an AML model validation, and they were installing smart ATMs, roving, through their branches and various ATM locations. Well, those were given a different product code. Well, risk-based due diligence would see in a description that these are ATM transactions, but they have a different product code. They were not being submitted to monitoring because they had a different product code that the compliance department was unaware of. They were monitoring the old ATMs, but not the new ones. And it was, a lot of money that they weren't being able to monitor. The methodology for scoring is usually some type of point system where you assign points for volumes of transactions, you assign points for product usage, channel usage, and location usage. We mentioned the high-intensity drug trafficking and financial crimes area. Those are the trend I have seen in that is that they are not really scored that heavily. They're usually given a minimum number of points because so many counties right now both qualify for either a high drug trafficking or financial crime area. And I'm beginning to think that maybe that is not the best approach, that we really need to find a more refined way of looking at not just this county is recognized as high intensity, but risk-based due diligence can look and see whether or not there are a lot of, drug activity, particularly in states where there's legalized marijuana, whether or not there's certain locations where those businesses are located, certain areas, and apply risk-based due diligence down to even a branch level. Most AML tools today have the ability to monitor by branches And a very good refinement that I'm seeing to account for this is to use it at a branch level. A good way is to identify risks a good way to set up your risk scoring methodology is to identify those risks. You just hit this one risk and you're automatically a high-risk customer. Now, this may be frequently dealing with international wires, particularly if you're a non-resident alien or if you have businesses that are located internationally. Gambling, depending on your industry code, gambling might be one. If you're near a port, trade finance, all of those types of activities may just automatically put you as a customer in a high-risk category. Then there are those risks where you say, okay, a customer who has two of these types of risks, we're going to consider him or her high risk, and we're going to take a look at those transactions on a quarterly or basis. And then there are risks where if you score three or more of these, we're going to consider you high risk. So that's how refined your risks have to be, that you have to know what are your most important risks, what risks combined together would give you a high risk customer, and then all your other risks are generally, if you have three of these, three or more, sometimes four or more, different methodologies and scoring points can be applied. These are the customers we want to look at. When I assess a customer's risk rating methodology, I usually come away with an understanding of, okay, a high-risk customer behaves like this. They look like this. They're in a high-risk industry, and they participate in high volume of moderate to high-risk types of transactions. I have a very good picture of what their high-risk customer looks like. The potential issue with this is if your institution allows non-bank customers to conduct transactions at your branches, such as purchase of monetary instruments like money orders, cashing checks, those types of things. Those are very difficult to score because we don't have a customer profile associated with those. So I also like to see within a risk rating methodology for those banks that allow non-bank customers to conduct transactions, a way of identifying those transactions, identifying those customers, and risk rating it. Now we're ready to move on to the next slide, which is about the coverage assessment. So at this point in the validation, we know what our risks are. We know what our highest risks are. We know what who our high-risk customers are, and we're monitoring them over time to see how our customer profile, our customer base, our product base, our transaction base is changing over time so that we can keep up with that. Now we need to make sure that we're monitoring the right data, that what we're bringing into our monitoring tool is complete and accurate, and most importantly, well documented. So the first thing I want to know is, are all the transactions input into the system? And this correlates heavily with some of the things that Chris is going to be talking about later. But what I like to see from my perspective is, do I have a good list of all the product codes, and do they map to transaction codes? Are there certain products where I should only have these transaction codes associated, and vice versa, so that I know I have a confined picture of my transaction base? Then I want to know, are all the transaction codes monitored? And there's usually some transformations that happen when you bring in different feeds. They'll have different formats of transaction codes, and they're fed into a monitoring tool as a consistent set that, mirrored together. So I have to be very careful about the transformations to transaction codes. Are they all accounted for? Then once I know I have all the products and all the transactions I need to monitor, then I can look at, do the transaction codes map to the rules? in the scenario? Are we covering the transaction codes and product codes that we should be covering in the rules? Are they there? Are they monitored? And this is how we tie the scenario design back to the risk assessment. There may be some transaction codes that are never monitored. For example, frequently there's a safety deposit box transaction code, and it's not frequently monitored. So that transaction code, I see it, I know it's there, and I see that we're not monitoring it. That I don't worry about. What we want to know is, based on the risk assessment and our customer profile, risk-based due diligence, did we identify the transactions and products and customers that we definitely want to monitor? And are they appropriately represented in the scenario design? To look at scenario coverage, I really recommend that you read each rule independently. And it's not unusual for us to find where a rule is written and structured inappropriately, so it's really not triggering alerts. The threshold is set much higher than what the monitoring threshold should be. So for a high-risk customer, you might want to monitor at 5,000, but if you have an overall threshold set at 10,000, you're not going to be getting what you want to get. Again, you want to make sure each rule or scenario can stand on its own and make logical sense. It should be able to generate alert. That's the basic test, that the logic within the scenario will allow the monitoring tool to generate an alert if the transactions support it. And we have found exceptions to that. Then you want to be able to tie and write an overall paper summary of how your scenario design ties back to your risk assessment. Now, again, the biggest potential here is that the compliance department is unaware of transaction codes or product codes that have changed, or that the KYC policies are not appropriately aligned with the data. That the KYC policy may say one thing, but the data doesn't really support that the KYC policy is being followed. This is particularly important when it comes to things like customer names, customer addresses, those types of things when you're going to try to monitor, all customers living at one address. It's really hard if the address is entered in inconsistent ways because a monitoring tool won't pick that up. But that's another place where you could pick that up in risk-based due diligence when you see data that's inconsistent like that. The data mapping is often, in fact, most times, incomplete and very difficult to translate. And we typically have to re-engineer data mapping, look at transactions from the production data, and then map it back to different types of product codes and transaction codes to make sure we cover it all. Now we're ready to move on to the next slide where we talk about watchlist filtering and country risk scoring. Watchlist filtering, I think this is one of the biggest areas for reputation risk at a bank because, if there's a person who is sanctioned and somehow they get an account set up at your bank, or they're able to conduct transactions with your customer base, that's a potential newsworthy item that could be very embarrassing. Not only to mention it's going to set off all kinds of regulatory alerts and that type of thing. So I do think that watchlist monitoring is very important, even though it's highly systematized in today's world. There's usually a service that is dynamic, updates it at least daily, sometimes multiple times a day. And so you have this, dynamic set of people and countries you're monitoring for. It's usually supplemented by monitoring in your production system as well, so that, these transactions are blocked before, they even hit the monitoring list. But we also want to make sure that control is working, so we monitor for it as well through AML. The most difficult part of this, of course, are the people and the names, and what's your algorithm for name matching, not only the real name, but the aliases. Again, this goes back to your data quality and entering the names. It also goes back to your data completeness, particularly for wires. Is the ultimate recipient appropriately named? Is the name complete and full so that you can monitor that field? And if you're not getting any alerts, the way I sort of assess this, if you're not getting any alerts on this, you might want to loosen up your algorithm a bit so that you do get some alerts that you can look at and clear. I just think it's a good way of reassuring yourself that it's working, number one, because you're getting alerts, and number two, that you're doing enough to monitor for, potentially sanctioned individuals. Next, we can move on to the performance side. One of the difficult things about AML modeling is the calibration and the setting of the threshold and monitoring performance. It's difficult because it's difficult to sometimes understand exactly what your monitoring tool is doing. It's a black box, and most vendors, in fact, all I've ever dealt with, consider it proprietary information to give you their data model, their specs, their design, their logical design. It's considered proprietary information. So what we as validators have to do is sort of re-engineer that and infer from the data that we have and the alerts that are generated exactly how the scenarios and rules are working. My general rule for thresholds and calibration is that the purpose of an AML monitoring tool is not to generate alerts. That's not the purpose. The purpose is to generate SARs. So I always look at a calibration methodology to see that it tightens the thresholds or loosens the thresholds to the point at which all previously reported SARs would be captured with those thresholds, maybe with a little cushion. And I think that's a very good way of assuring yourselves that I'm not tightening my threshold to the point where previously identified SARs would not have been captured. You want to make sure that that baseline is met. And then, of course, you want to continue to monitor your customer profile and your product profiles, your transaction profiles, to make sure that your data is consistent or to measure how it changes. With that, we can move on to the management reporting. And I've looked at the BSA examination guide for years, but it just recently really hit me that one of the steps in there is that the management reporting data should be tested for accuracy. And I had looked at management reports that go up from AML for years, and frequently they come out of the AML tool, but I never really grasped that should be submitted to some sort of testing, even if it's just reasonableness testing, to make sure that the information that you're promoting to management is a good representation of what is happening within your compliance department. I also think this is a really good way to promote AML compliance within your organization, and I think it's a very good way to include some information about recent SARs. Let me tell you about a couple of recent really interesting SARs that we filed, because it makes the board and the risk committee and whoever else you're reporting to really understand the importance of the role that the compliance department plays within your organization. It sort of brings it to life, and I think it's very interesting for managers to see that. So I always like to see that type of information used to promote your department as well. And with that, I'll turn it over to Tim, and he can talk more about the back end and the data level work that we do during a validation.
Thanks, Susan. We're actually going to turn it over to Chris, who's going to talk about those things.
Thanks, Tim. So for this, I'm going to give more of a high-level approach of sort of how we test the system. So how we test the system, the model, ensure it's working correctly. And as opposed to what Susan was talking about, this is more testing the technical level of everything, but it does lead into tuning the model in the future, since you sort of have to do this step first. So the first step we normally do is called above-the-line testing. And basically what this is doing is looking at a sample of alerts. We usually do 1 or 2 for each rule involved, and kind of making sure that these are triggering correctly. So what we normally do is get a list of every rule, pull a few sample alerts for a certain period, and then pull data, usually in their interface system, on each customer that these alerts were triggered for, or each transaction, and make sure that these should have been triggered. Sometimes you'll find that these alerts were triggered for no reason, which could be due to some variables being incorrect. Now, the value of this, since we're just sampling alerts, it doesn't cover every transaction, won't cover alerts that should have been triggered but weren't. But it's a good way to test the system as opposed to just looking at the raw data, since it's at the end product level. I like to start with this first because it is fast. Usually within a week you can do a pretty preliminary review of every single rule. And personally I like to start with this because it encourages familiarity with the data and the rules. A big part of this is interpreting what the rules actually mean, as opposed to just coding the logic behind it. And so this is a good way to communicate with the customer, whoever's in charge of managing the rules, figuring out what the rule actually means, or sometimes it's the case, figuring out what the customer actually wants the rule to do, as opposed to the logic that's listed. Another value of this, and Susan touched upon this a little bit, is that you get a summary of the count of alerts per period of time, maybe over the past year. And if you see that a rule has triggered no alerts, then that usually means either the logic is not triggering correctly, or that you have to loosen the thresholds for those to get some more alerts in. So the next test that we do is called below-the-line testing, and this is a lot more comprehensive. And what this is doing is, as opposed to looking at a sample of alerts, we're sampling data, so maybe the past month or 2 months of transactions, and recreating the actual alert logic in the data, and to ensure that all the alerts are being triggered. So this is really the ultimate way to evaluate the model, because it's thorough and evaluates specific rules, since you're actually recreating them. It can also catch logic issues. So one that I found before is that if it's looking at a sum of weekly wire transfers over the past week, sometimes week is sort of a loose threshold. It could be looking Monday to Monday for business days, or sometimes it goes Sunday to Sunday. So that seems like a small issue, but it can lead to a difference in alerts because of how it's being grouped. Now, the issue with this is that it can be very difficult to map. You really have to understand where the data is coming from, understand the database. So that can be dealt with in a variety of ways. Usually, you have to use a combination of them. So the first step is always to work with any database administrator or analyst, since they're the ones who are working with the data. However, a lot of times, the bank will not have a good understanding of the data. It's, like Susan said, it's more of a black box, and their system is just pulling in the transactions. So if there isn't anyone involved who actually understands the database, we sometimes like to work backwards from published reports. And these aren't necessarily just AML reports. So if we have a list of wires, ATM transactions for a set period of time, we're able to use that sort of as a pin to work backwards with the data, and sometimes check the tables that have names that seem relevant. If that doesn't exist, we can just go through all the tables, query them, and check record counts for certain periods of time and see if those match up with the published reports. So that's a good way if we have no help with the database, how to get back to the data. And just sort of background, sometimes it's really easy. Sometimes there's, only 20 tables, and then you can go through each one thoroughly, figure out what they mean. But sometimes there's just an excessive amount of data where you're looking through 5,000, 10,000 tables. Most are useless data, and just no one has any idea of what the tables mean. And that's where you really have to start digging around, automating queries to evaluate them, since it would be very time-consuming to go through 5,000, 10,000 tables manually and understanding what they are. So next, I'm going to share an example of a pretty simplified example of some below-the-line testing. So a lot of the times the system logic doesn't even have sort of a mathematical formula for what's happening. So in this case, the system logic just says identify accounts that conducted individual cash withdrawals of $15,000 or more within the last completed calendar month. So below is what we would do right in SQL to query their databases and come up with a list of accounts that should have triggered this. So basically, instead of an English description, you're pulling from the table of transactions, you're pulling account number from the transactions table, filtering based on transaction date, looking at transaction type equal cash. If there's a debit credit indicator, it'd be debit. For this case, otherwise it'd be credit, and then filtering based on the amount. So again, this is simplified rule. Sometimes they're a lot more complicated, looking at standard deviations or rolling month averages. But I just wanted to kind of give a little insight into what this involves. And then when you run this query, we'll get a list of the actual accounts that should have flagged for this. We can compare it to the alerts that did flag, and you can have either too many being triggered or too few being triggered and work from there. All right, Tim?
Okay. Thank you, Chris. Okay. We do have one question about customer risk rating. Which components of customer risk rating do you consider most important? Susan, you talked a little bit about this earlier. Do you have any insights on, obviously there's some elements of KYC customer risk rating that are, more important than others, some that might be used unnecessarily. Do you have any experience there?
Yes. Where I have seen risk manifest itself in the customer base are a couple of places. One is with opening online accounts where you don't have to have a face-to-face interaction to open an account. That's number one. I like to see extra care taken to monitor those types of customers. The second type is what I mentioned when I was speaking, the non-bank customers, people who come in and conduct transactions, particularly purchasing something like a monetary instrument, that gives me pause. And frequently those customers, and they are customers because they're conducting transactions at your bank, are not monitored as non-customers. They might be monitored as a product, as a monetary instrument, but they're not monitored that the same person who's a non-customer comes in every Friday and purchases a monetary instrument. And then the third thing I like to look at, again, is what I talked about with risk scoring, where you put a customer who might have some mediocre risk, maybe they do international wires, but you put them together with either a geographic location, such as, a higher risk country, or you put them together with a higher risk industry, like trade finance or, in a gambling area or, industry or something like that. I think it's looking at, again, where your risks are for your bank and who your customers are, making sure you know who they are. they should surface pretty quickly, but those are the standard types that I see that pose risks that aren't necessarily monitored closely.
Okay, thank you, Susan. One more question here. How often do rules need to be checked for above the line and below the line testing? I'm wondering if, do you think that means how often do we run above the line or below the line testing, or?
Well, yeah, I think you definitely should run those tests whenever you have a rule change. But I guess there is some value in regularly running them, just in case the database changes, the data format or the data that's being put into the model. Sort of what Susan was talking about, where the ATM code changed. If you run it one time and then don't look at everything for 10 years, you might be missing a lot of alerts. So it probably depends on the bank, or the situation. But the nice thing about at least the below the line testing is you're writing these queries that basically involves filtering through the database. So once you have those written, it's really easy to run them. The legwork is really more in building the queries, understanding the layout of the database. But once those are written, you can run these tests really quickly anytime. So it's hard to give a specific time, but there is definitely value in running them as opposed more than once on probably a regular interval. Depends on the bank, but it is really easy once you do the initial review.
Awesome, thanks. Everyone, really, really appreciate your questions. We're actually running up against time here. We've gotten a few more. We want to let you know that we've taken note of those. What we're going to do is follow up and provide some individualized responses via email. And if we need to set up a call, we can certainly help to address these. So I want to thank everyone for their time. We really appreciate it. Thank you to all our speakers for giving some insight to us today, and look forward to connecting with you and addressing any further questions you might have. Thank you very much.